Now that we've created financial statements that have been adjusted to properly reflect revenues and expenses in the correct period, we now have to be concerned with making sure that the next period is a clean slate and that we've zeroed out all the accounts that need to be changed because we're in a new period. We call this closing the books. On our ledger, we have two different types of accounts. We have what we call temporary accounts and permanent accounts. Temporary accounts are all the accounts that need to be closed out after we've created our financial statements and we're ready to go into the next period. Permanent accounts will maintain their balances and will carry over into the next period. So note in the temporary accounts that accounts that need to be zeroed out are the income statement accounts, the revenues and expenses, and the dividend account. The permanent accounts that will remain on the books and carry over into the next period are all the assets, liabilities, and the stockholders' equity accounts. So when we close the books, we need to make a journal entry to close out the revenue accounts, the expense accounts, and the dividends accounts. We can look at this as a four-step process. We know that the normal balance of a revenue account is a credit. So in order to zero out an account that has a credit balance, we need to do a journal entry that debits the account to create it to zero. So therefore, we would do a debit to the revenue account to zero out that account, and the offsetting credit would be to the income summary account. The income summary account is a temporary account that will eventually be zeroed out at the end of the period when we finish the closing of the books. The expense account is a normal balance debit account. So when we want to zero out each expense account on our ledger, we need to do a credit entry to zero it out. Once we've accumulated all the credit entries to zero out the expense accounts, we can make a single debit entry into the income summary to reflect all the credit entries that we made for the expenses. Once we have completed the debit for all the expenses and all the credits for all the revenues in the income summary, we can reduce or zero out the income summary into retained earnings. Remember in our retained earnings statement when we said take the beginning retained earnings plus net income minus dividends gives you the ending retained earnings? Well, the entry to zero out the income summary is the net income entry being entered into the retained earnings account. Once we've zeroed out the income summary as step number 3, we can go to the fourth step and zero out the dividends account. We zero out the dividends account by remembering that the dividends normal balance is a debit. So since the dividends account is a debit, we would need to decrease the dividends account by an adjusting entry of a credit, and then we would debit the retained earnings account. Remember, the retained earnings account's normal balance is a credit, so when we zero out the dividend with a debit into retained earnings, we will be reducing retained earnings. So here is a quick list of the 4 steps to close the books. Step 1, close out the revenue accounts to the income summary. Step 2, close out the expense accounts to the income summary. Step 3, take the entries that you did in steps 1 and 2 and zero out the balance in the income summary into retained earnings. Step 4, close out the dividends account into retained earnings. So this is what the journal entries might look like for Sierra Corporation. In journal entry number 1 to close the books, we reduce the revenue account with a debit and a credit to income summary. In the second journal entry, we get rid of all the expenses, so we're going to debit the income summary and credit all the various expense accounts. And once we do steps 1 and 2, all the temporary revenue accounts and the temporary expense accounts will now be 0 for the next period. Journal entry number 3 is to take the balance out of the income summary, and notice the $2,860 in this income summary entry is the same number as net income on our income statement. We reduce the income summary by that amount and we credit retained earnings, which will increase the retained earnings account for the net income being recognized. And then step 4, we would reduce retained earnings with a debit, and we would reduce the dividends account with a credit. By doing so, we have now zeroed out the dividends account. So here is a graphical view of what we've done to close the books. Step number 1, we reduce the revenues account with a debit to the revenue account and a credit to income summary. Step number 2, we've taken all the expenses in all the expense accounts and done credits and took the total and did a debit entry into the income summary. If you look at the difference between the credit entry of number 1 and the debit entry of number 2, we show that we have net income of $2,860. That net income needs to be reduced out of the income summary and increased in the retained earnings. So step number 3 is a debit to income summary and a credit to retained earnings. If the company had had a loss, the entry would have been a reverse, in that we would have had to done a credit to the income summary and a debit to retained earnings. Step number 4 is the reduction of the dividends accounts to 0 by doing a credit to the dividends account and a debit to the retained earnings account. Once we've completed steps 1 through 4, we have now closed out the books and we are ready for the next period. Now, before we leave this slide, take a look at the income summary. The income summary T account can tell very quickly how the company is done as you close the books. Remember that the credit entry was a reduction of the service revenue account and recognizes the total revenues of the company for the period. On the debit side, the debit entry is the zeroing out of all the expenses. So those two items, number 1 and number 2, are the revenues minus expenses. And item number 3 is the net income that we use to zero out the income summary. Once we've closed out the books, we should perform one more trial balance called a post-closing trial balance. The reason why we do a post-closing trial balance is we want to list all the accounts with balances to ensure that the debits equal the credits. Also, we want to make sure that we have identified all of the temporary accounts and that we've closed them out. So, in summary, what we have talked about is the accounting cycle. And as you can see from this graphic, we start with number 1 of analyzing a business transaction by looking at the source documents. We record the transaction in the journal, which is in chronological order. Once we complete the journal entries, we post the journal entries into the ledger in account order. Once we've completed all the entries for the period into the ledger account, we take the balances and create a trial balance to ensure that the debits equal the credits. Once we know that the debits equal our credits in our trial balance, we take a look at that trial balance and determine if we need to make any adjusting journal entries to properly reflect revenues expenses for the period. After we've posted the adjusting journal entries into our ledger, we then prepare an adjusted trial balance to once again ensure that our debits equal our credits. We can then prepare a financial statement, and then upon creating the financial statements and we prepare ourselves for the next period, we create post-closing journal entries to close the books, and we post them and then do another trial balance, because then we're ready to start the next period.